Last month, I caught a business owner overpaying the IRS by $24,000. Same income as his neighbor, completely different deductions. And in 2026, that gap is wider than ever. In this video, I'm showing you the 5 categories of everyday expenses you can legally turn into tax write-offs in 2026. Plus, a major change under the One Big Beautiful Bill Act that most CPAs haven't even mentioned to their clients yet. So stay tuned until the end. The bonus deduction alone could save you tens of thousands of dollars every year. I'm Henok Kebede, founder and CEO of HK Financial Advisory, based out of Washington, D.C. area. I've been a licensed CPA for over 13 years. Before launching the firm, I built internal audit and controls programs at Fortune 500 companies like Deloitte and Verizon. That background matters here because the difference between a deduction that holds up in an IRS audit and one that doesn't is documentation. And that's exactly what I'm going to walk you through today. Let's get straight into it. The home office deduction is the foundation. If you run any kind of business and use part of your home regularly and exclusively for work, you qualify. That word exclusively is the trap. See, your kid cannot do homework on that desk. Your spouse cannot fold laundry in that corner. If the IRS audits you, they look for one thing. Was the space used for one purpose only? Now, here's where most business owners leave money on the table. The IRS gives you 2 methods. Method number 1 is called the simplified method. So take $5 per square foot, capped at 300 square feet, so $1,500 maximum. Easy to calculate, easy to claim, but capped low. Method number 2 is the actual expense method. So you take the percentage of your home used for business and apply it to real costs. So like rent, mortgage interest, utilities, internet, home insurance, even repairs and maintenance. Let me give you a real example. So I had a client come to us, a DC consultant, had 250 square foot office in a 2,500 square foot home. So that's 10% business use. Her actual home expense ran about $48,000 for the year. Under the simplified method, she'd get only $1,500. Under the actual expense method, she'd get $4,800. So same office, 3 times the deduction though. So here's mistakes to avoid. Claiming a home office that gets used for personal activities. If the space isn't exclusively for business, you do not qualify, period. So best practice is to take photos of your home office. Keep a floor plan with square footage written on it. Save your utility bills. If the IRS comes knocking, you want this airtight. This is the kind of documentation system we build with every HK Financial Advisory client. If you drive for business, and most business owners do, your vehicle is a write-off. You have 2 methods, so the standard mileage and the actual expenses. So standard mileage is simple math. For 2026, the IRS announced the rate is 72.5 cents per mile. That's up from 70 cents in 2025. So you multiply your business miles by that rate. So let's say you drove 18,000 business miles in 2026. That's $13,050 deduction. Actual expenses is more aggressive. So you total every vehicle cost like your gas, insurance, repairs, registration, depreciation, and apply your business use percentage. But here's what most CPAs aren't telling their clients. Under the One Big Beautiful Bill Act, 100% bonus depreciation came back permanently. That means if you buy a heavy vehicle over 6,000 pounds gross weight and use it more than 50% for business, you can potentially deduct the entire purchase price in year 1 alone. We've had clients buy $80,000 SUVs and deduct the full $80,000 the year they placed it in service. That's not a loophole. That's Section 179 plus restored bonus depreciation, exactly as Congress wrote it. So here's some mistakes to avoid. Commuting miles do not count. Driving from your home to your main office is personal. Driving from your home office to a client site is business. So mix those up and the IRS will throw out your entire mileage log. All right, so best practice is use apps like MileIQ or Everlance. Track the dates, miles, business purpose for every trip. And if you're switching from standard mileage to actual expenses, talk to your CPA first. There are timing rules that can lock you out for the life of the vehicle. This is the kind of strategy we run for our clients before they sign the next vehicle purchase. The decision you make on the dealer's lot has tax consequences 5 years out. This is the section where I have to interrupt every CPA on YouTube. In 2026, the rules on business meals changed under the One Big Beautiful Bill Act, and most business owners haven't been told. Here's what stayed the same. If you're taking a client to lunch, a prospect to dinner, or a referral partner for coffee, you can still deduct 50% of that meal. Entertainment is still zero. That hasn't changed since 2018. Here's what changed. Before 2026, if you bought meals for your employees on site, keeping them late at the office, stocking the back break room with snacks, running a small cafeteria, you could deduct 50% of those costs. Starting in January 1st of 2026, though, that deduction is gone. Zero. Under the new code section 274.0, employer-provided meals for the employer's convenience are no longer deductible at all. That includes the pizza you bought your team during overtime, the coffee you stock in the break room, holiday snacks, donuts, the on-site cafeteria. If you have employees and you've been feeding them as a perk, your after-tax cost just jumped. What's still 100% deduction, though, is meals provided to the public at promotional events, company-wide holiday parties open to all staff, and meals included in employee wages. All right, so here are mistakes to avoid. Assuming nothing changed, avoid that. If you're still expensing break room coffee at 50% in 2026, you're claiming a deduction that doesn't exist anymore. All right, so that's the kind of error that gets caught in an audit and triggers penalties. So best practice is to separate your meal accounts in QuickBooks into 3 categories: client meals, public promo meals, employee convenience meals. The first 2 still produce a deduction, the third does not. So for documentation, every business meal needs the date, the location, who was there, and what was discussed. Photo of the receipt, note on the back, done. This is most overlooked One Big Beautiful Bill update in 2026. And it's exactly the kind of update we're walking every one of our clients through right now. Your laptop, your phone, your subscriptions, all of it, deductible. Under Section 162A, any ordinary, necessary, and reasonable business expense gets written off. Tech is built into how every business runs in 2026. All right, so laptops, monitors, printers, headsets, ring lights. If you bought it primarily for business, you deduct the full cost. And because 100% bonus depreciation is now permanent under the One Big Beautiful Bill Act, equipment over $2,500 does not have to be depreciated over 5 years anymore. You can take the entire deduction in year 1 alone. That's a structural change you need to understand, because before One Big Beautiful Bill Act, a $3,000 laptop got depreciated $600 a year over 5 years. Now it's all $3,000 in the year you place it in service. Your cell phone follows the same logic. So if you use it 80% for like business, calls, text, email, scheduling, and content creation, you deduct 80% of the phone and 80% of the monthly plan. Now, subscriptions. This is where business owners forget the most money. Pull up your credit card statements right now. Every recurring charge for business software, productivity tools, AI tools, design platforms, all of it is deductible. So like ChatGPT Pro, Claude Pro, Microsoft 365, Google Workspace, Adobe, QuickBooks, Zoom, Slack, Dropbox. If you use it to run your business, it's a write-off. So here are some mistakes to avoid. Running business subscriptions through your personal card. Clean separation matters. All right. The IRS does not want to untangle which Netflix subscription was business and which was personal. So best practice in January of every year, build a 1-page subscription log. App name, monthly cost, business purpose. That's your audit defense if anyone asks why your software bill ran $9,000 last year. When you travel for business, the deduction stack is enormous. So like airfare, hotels, rental cars, Ubers, baggage fees, tips, in-flight Wi-Fi, dry cleaning, and laundry if you're on the road for more than a few nights. But there's one rule that wrecks most business owners. The trip has to be primarily for business, not 51% personal with one client call tacked on. Primarily for business, meaning the main reason you went was business. That means itineraries, meeting agendas, calendar entries, receipts. If you went to Miami for a conference and added 2 days at the beach, the conference days are deductible. The beach days are not, but the flight is fully deductible because the primary purpose was business. I had a client try to deduct a family Disney trip because he had one Zoom call from the hotel. The IRS does not care about the one Zoom call. The IRS cares about why you left in the first place. Now, education. So like coaching, books, courses, conferences, masterminds. Anything that helps you maintain or improve your skills in your current business is deductible under Section 162A. But here's the limit though. It has to relate to your current business. So going to law school to become a lawyer when you're currently a real estate agent does not count. That prepares you for a new profession. But hiring a sales coach to grow your existing business is deductible. Buying a $5,000 marketing course is deductible. Attending an industry conference, it is deductible. So like flight, hotel, your registration, 50% of the meals, and your Ubers on that trip. This is one of the most underused deduction categories for high-income business owners. Most of you watching are already spending money on growth, like courses, masterminds, and coaches. You're just not getting the tax benefit because nobody told you to run it through the business. So here's some mistakes to avoid. Paying for business education with your personal card. Run it through the business account. Document the receipt. Done. Here's the bonus that pays for everything I just covered. Under the One Big Beautiful Bill Act, the Section 199A qualified business income deduction was made permanent and expanded. If you own a pass-through business like LLC, S Corp, sole proprietorship, or partnership, you can deduct up to 20% of your qualified business income before federal tax. You make $200,000 in business income, you deduct $40,000 off the top. That's potentially $14,000 in federal tax savings every year automatically. Starting in 2026, the phase-in range expanded, so most high earners now qualify. And there's a new $400 minimum deduction for active business owners with at least $1,000 in qualified business income. This is the deduction your W-2 friends will never get. It's reserved for business owners, so under the One Big Beautiful Bill Act, it's now permanent. No more 2025 sunset. If your CPA isn't optimizing your entity structure around this, you're paying the wrong CPA. Here's the bottom line. Tax planning does not happen in April. It happens before December 31st. You cannot go back and claim a deduction you did not document. If you're a business owner making over $250,000 a year and you're not sure your current CPA is up to date with the One Big Beautiful Bill Act, click the link below to book a strategy session with my team at HK Financial Advisory. I spent 13 years building internal audit and controls programs before this. We don't just file your taxes. We build you a defensible audit-proof system that legally minimizes what you owe. Tax season is too late. The window to plan 2026 closes December 31st. So book the call. I'll see you on the next video.